Hi, and welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week, where we're going to do a tactical update on the portfolios and cover off what's going on in the markets. As always, keep in mind that everything we cover on here is for information purposes only. Always do your own due diligence or reach out to us. Always happy to answer any direct questions or take a look at your particular situation and help you out with any ideas or questions you have about your own portfolio or financial plans. Everyone's different in that manner. It's always worthwhile getting direct information. So with that, remember, everything we cover on here is for general purposes and not specifically for your situation. So with that, let's talk about what's been going on in the market. It's been a lot of things happening since we last talked. Obviously, we have a pretty good rally over the last month or so in the markets, driven mostly by optimism, and I'll get more details on that when we get into the tactical part of the conversation. But let's take a look on what's looking at in the broader markets. Obviously, we have a big meeting coming up in Jackson Hole, where the Fed Reserve is going to talk about where things are going, or more so what the policy is going to be going forward as far as interest rates go. That's really what's been driving this rally. A lot of people, read into the last couple of meetings that the tone of the U.S. Fed was getting a lot less hawkish. The thought that maybe, they might be done or easing on those interest rate hikes. That's not really the case. We'll talk a little bit more about that, but it's going to be really important to kind of see what the language coming out of this meeting is going to be. As we even saw yesterday, a big sell-off from the rally we had for the weeks prior, just on that concern that it might be back to hawkish, or that they're going to stick with the more aggressive interest rate hikes. As we get more. The interesting thing about it is they never said they were going to stop doing the interest rate hikes, just that they might not have to do as aggressive ones. So we'll dive more into that, but let's put that aside for a little bit as we look at what's going on. Obviously, around the world, there's still a lot of concerns around inflation. We've seen more interest hikes in Indonesia and other countries as inflation starts to peak in those areas as well. The U.S. dollar jumped to a 2-decade high against a basket of currencies or global currencies, and whenever we see a spike in the US dollar, that the market's getting a little concerned or a little bearish. It's the flight to safety trade. We always see the US dollar show strength whenever there's concerns in the market. So, if you want to read anything into that, that's pretty much a message that we're likely to see some more pullback here. I don't want to say that that's a negative part of our outlook. It's not. It is something that we are expecting, but the market had kind of got caught up a little bit in this rally recently. Oil prices rose slightly after OPEC Plus got together and talked about potential cutting the supply back a bit. And we will obviously have ongoing concerns about fuel pricing and fuel shortages, especially on the natural gas side over in Europe, and even here in the US, the price is increasing. We saw copper down a little bit again, just based on that concern about the meeting this week. But overall, the sentiment around metals in general is that the demand is still high as the global shift to renewable energy continues, and obviously very metal heavy technology goes into those renewable energy sources, not just the vehicles. I know there's a lot of talk about the EV vehicles, which is a big part of it, but in the grander scale as well. Other news out in the markets to kind of keep an eye on: Tesla's stock split is coming up. So Tesla is the latest mega cap company to go down the stock split road. Stock splits have kind of been on the decline in popularity over the last few years. Although we have had a pickup here in 2022 with Amazon and Google, or Google's parent company, Alphabet, doing their stock splits in 2022. Really what we're, the idea behind it is to get the price or the price per share down, that it's more accessible for everybody's portfolios or more people's portfolios. And it usually signals to the market, or at least the market usually interprets those signals as management's confidence in the stock performance going forward. So it often does lead to a bit of a bump in the stock price when they do the split, but not always. So we'll keep a close eye on those and see if there's more trends around the stock splits as we kind of move forward. We're also seeing, there's a group of Apple employees that are protesting the company making a 3-day in-office policy. This is actually going to be a bigger part of our conversation today. This is why I wanted to bring it up. So basically, during the pandemic, people work from home, especially in the tech world. And now that we're moving out of that phase of the pandemic or of COVID, there's a lot of pushback by employees to not want to go back in the office, or certainly not want to go back in full time into the office. And as companies out there put in policies in place to kind of mandate return to work or return to office, there's been a lot of pushback, and Apple being a good example, where they're looking at a 3-day in-office policy, and they're getting a lot of pushback from employees. So that's going to lead a little bit more into our conversation of what's going on in the portfolios and the markets in general. Natural gas, as I mentioned, kind of 14-year high around that. We're seeing big demands build up in the U.S. Pricing continue to increase, but also globally, especially the European countries, of course, with Ukraine and Russia, or the Ukraine-Russia war continuing. And choking the natural gas supply coming out of there into the rest of Europe. America's also, office glut. So, we talk about real estate and interest rates. We're seeing an office glut in the United States. And some will argue maybe spurred on by the pandemic, certainly highlighted by the pandemic, but really it had been building up for years. We've seen like an ongoing push when it comes to, where we saw an ongoing push to building new office buildings all through the United States. You can't build forever. Eventually, your supply is going to outpace demand, and we'll see. And we're starting to see that start to crack in the United States. So, when you're looking at real estate investing, obviously there's a lot of concerns everywhere. With the higher interest rates. But, office space in particular is a big concern. Here in Vancouver, people don't see that as much, as we don't necessarily have a glut. We might actually still have a bit of a shortage, but other parts of the country, we can certainly start to see that happen. I mean, we've seen it in Calgary, again, pre-pandemic, and Edmonton, and Toronto, as they start to kind of reopen again. As we'll start to get some more numbers out of that, but something to keep a close eye on when we're looking at real estate. Obviously, industrial still doing super well. Residential starting to ease off a little bit, and now we're starting to see cracks in the office space or in commercial office space that we kind of always knew it was going to come through. So a little bit after the pandemic, but it's really highlighted the glut that existed before the pandemic as well. So with that, we also have a lot of earnings coming out this week, so keep an eye on those. We have the Canadian banks reporting, so that's going to give a bit of insight to the economic numbers for Canada, to see what's going on with lending and kind of their fiscal outlooks. We also have a lot of the U.S. retailers with Macy's, Nordstrom, Dick's Sporting Goods all reporting this week. Kind of going into or in the middle of earnings season, so we'll continue to see those develop as we go. But with that, let's move on. Let's talk about the portfolios. Let's talk about the tactical update out there, and of course, the ongoing theme, as you've just heard from kind of what's going on in the markets, is interest rates, inflation, it's still there, but we're going to make a bit of a shift today. I know I've been talking about them quite a while as being the driving forces in what we see in the portfolios and in the markets, but we're kind of getting played out on that story, right? Everyone knows that inflation's there. Everyone knows that it's been looming, to highs. We've seen some of the most aggressive interest rate hikes to offset them, and I've been saying for months now, one of the things we want to look for is for that inflation, those inflations to turn over, and they're starting to turn over, right? The U.S. came in at 0 last month. Canada definitely off the peaks. We've definitely seen the price drops happen in consumers goods when you go out and buy things. Obviously, we're not seeing it as much, but we are seeing it in fuel and food. Food seems to have held on the longest, but we just got reports. Meat, for example, indexes just started to drop. We're still seeing some agriculture items staying up there on the food side of things, but things are starting to turn. So we know that story is playing out, which is good, good news when we talk about bringing it under control and getting the market back. But it's not completely gone. There's still more interest hikes to happen, but that story's kind of played out. We know how it's going to go. We know where we're headed with inflation. Obviously, the rate cuts are going to bring them down and kind of get into things. So where does that lead us? Do we get into that recession? Well, that's an interesting story. All things considered, we've had a couple of reports of negative GDP growth in the United States. Does that mean we're already in a recession? It takes 3 to say we're for sure in a recession. Will we get there? That's still kind of a guess. I think we're probably going to touch on a recession, or if we don't officially, report a recession, we certainly got in the realm of recession. Will we avoid it completely, or will we recover from it really quickly? Well, that's going to be our main discussion when we talk about the portfolios. What do we need to be looking at that? Because we've already had the aggressive interest rate hikes, and we have more to come. We already had the high inflation, those things. But there's one aspect that hasn't really kind of played out yet, that that we need to really put our fingers on and take a look at. So when we look at the flip side of that, the interest rate hike, that's what's really interesting in this rally we've just had. And although we did raise some cash in this rally, in our recent rebalance in the portfolio, as I talked about a couple of weeks ago when we did our last update, was we're looking to deploy that. We're looking for that pullback because the market kind of got used to, less bad news became good news, and that's what kind of drove this rally. So the Fed kind of indicated, oh well, it's we might not have to be as aggressive. The market took that as good news, and we're going to rally things up. But they didn't say we're not going to raise rates. They just simply said we're not going to have to raise them more than maybe we've already planned on. So there's still another rate hike coming here in September. We know that's coming in, but the market seemed to have lost sight of that and drove things up. So we are expecting a pullback because things got a little too frothy here. And I think yesterday's market kind of showed that with just a little bit of news that the U.S. Fed might not be easing off as much as the market expected. We saw a pretty red day, as people pulled profits out of there. So interest rate hikes, we know, there's still another one coming. It's not over, but we know that's happening, right? These are all played out stories. We can look forward and say, okay, we know these things are going to happen. So we can kind of look at the market and say, where do we want to be? So, where do we want to be? We want to be in cash flow companies. There's a lot of great companies out there that have had, maintained very strong cash flows through all this, or even increasing some cash flows, through, cost efficiencies and using more technology to kind of increase the profitability and the margins. So if you look at the portfolios we have right now, we're focused on industrials. We're focused on cash flow companies that have been increasing dividend. I'd say about 30% of the names we have in the portfolio had increased dividends in 2022. So all really positive movement on cash flows. Yes, they've had some fluctuation on the stock prices, but that's fine. We can wait, right? We're getting paid, dividends anywhere from 4 to 8.5% in the portfolios right now, and that's really positive coming in. That cash flow is very positive coming in there, and also giving us more cash in the portfolios to take advantage of the prices. So have we got into did we hit the bottom in June? Right, June was the lowest point of the market so far. Well, that leads into the bull versus bear fight. So are we going to retest that bottom? Very possibly. We do certainly expect to pull back here in the next little bit as the market wakes up to the fact that all the bad news isn't gone. There are still stories to play out when it comes to this interest rate inflation back and forth. But that's why we have the cash in the portfolios. We're looking to jump on those opportunities. It may not retest the bottom. It might retest the bottom. It might even go slightly lower than that. It might, take a little bit more. Probably not. I don't know if we'll actually retest the June bottom. But that's part of the story that we have to play out here. And really where it's going to come into, what's going to come into play here is this new theme we have to think about: unemployment. So we've had, this massively high inflation. We've had some of the most aggressive interest rate hikes over a short period of time in history, or certainly in the last several decades, to bring down that economy and slow things down. But the one thing that we haven't really seen yet is unemployment numbers rising. So we've actually continued to see unemployment numbers eking down. They're really low levels. But we need that to turn, right? Before we can slow the economy down, because that's what we need to do. We need unemployment to start to increase a bit. We don't need it at 9 and 10%. We just need the trend to kind of reverse, where unemployment is coming up a little bit to a slower economic level. So that's the number we have to look at. Unfortunately, the unemployment numbers are very backwards looking. We've talked about, same thing with inflation. They're very backwards looking. So by the time they actually turn, they are going to, we would have already been a month or two into that shift. So we're going to really take a look at what's going on with employment, which goes back to my earlier comment about looking at things like Apple employees saying they don't want to come back to the office. And we're seeing that everywhere. If you talk to any of the hiring managers out there or the HR specialists out there, one of the big things employees are still looking for is that freedom that they had during the pandemic, to work from home or work remotely, not have that commute come in every day. And hey, there's a lot of argument for that to continue. Obviously, productivity numbers didn't drop that much through that period of the pandemic. And there's, there can be, certainly in a lot of roles, there could be a continued argument that for that to happen. But the reason we're seeing that so much right now is because, employees have the power right now. Employers are looking for talent, they're looking for experienced talent, and it's tough to get out there. It doesn't matter what industry you're looking at. We see it the most in the service industry, simply because that's where we go, and we see, everyone gets to experience, a restaurant, if you're a hotel, or, air travel. Of course, we've seen all that happening. The problems of not being able to get enough staff or trained staff to fill the gaps or to meet the service needs out there. But that's true everywhere. Doesn't matter what industry you're in, it's tough out right there to get skilled labor or trained labor, experienced labor, whatever you want to call it. So we need that to move. So that's the number we're watching. I know for the last year I've been chanting, keep an eye on inflation, keep an eye on interest rates. That story's played out now. Now we're looking at employment. That's the last kind of pillar to fall to really see the economic shift that will maintain those inflation numbers down, and then maybe we might even see an interest rate cut late this year, early next year. But all this is still playing out pretty strong for some good news in the last quarter of 2022 as far as the portfolios go. Remember, we're really looking for that one last kind of pullback. That doesn't mean it's straight up from there, but one last strong pullback in the portfolio. We're going to be aggressively deploying that cash into those strong cash flow names. Again, we know that even after we make that move, patience is going to play out, and you can see by the graphic over here. I just came back from a weekend fishing trip, so patience I had to learn as I sat on a boat for hours waiting for the fish to bite. But that's the same with the portfolios. We want to be patient, so we're not going to chase this rally up because it's probably temporary. What we want to do is go into the right names at a reasonable time. We're not going to get bottom, but we're going to get those cash flow companies that are going to pay us as we go into a recovery. And if you've ever been through one of these pulls back before, it's those first yields off the bottom that we want to grab. Because by the time the market gets bullish, all these backwards numbers get caught up into the markets and the economy. There's already been that 5-10% lift. So that's what we want to make sure we take advantage of these lows, is on the next pullback, really take advantage of having been patient, kept the cash in the portfolios, and jump into those names and start getting paid more and more of those dividends and creating more cash flow in the portfolios. So that's kind of what's going on in the portfolios. We are bullish going into the end of the year. Remember, thanks for listening to these. We're going to keep them pretty steady. I'm going to be away. I'm going to try to make sure I get another update out even while I'm away for the first part of September. But we'll try to get that out. But always you can go to mikeonmoney.com. That's the portal on our website. You can see any of these videos that you've missed that you want to catch up on. We have a lot of other ones. We have new series coming out as well, more on the small cap venture investing side of things. My partner Harold Leishman is going to host some of those, so those are going to be coming out. But we keep track of them all there at mikeonmoney.com, and you can forward them on. But also you can reach out to us through that portal if you have any questions that you want us to address on here, any particular aspects of the portfolio, investing, news, anything that you want to hear about. Let us know. We always like to hear feedback and how we can improve these and get more information to you and your specific situation. So with that, thank you again for joining us this week. Hopefully you're enjoying the end of your summer as we start to wind down August and head into September, which is always a fun month in the market as everyone gets back and volumes pick up again. So we'll keep you apprised of all things market and portfolio related. With that, thanks again. Take care, everyone. Bye-bye.